Welcome to Talk Tickers. Today we're digging into Tillys, ticker TLYS. And really, their whole story this quarter comes down to one single number. It's a number that, believe it or not, tells two totally different stories at the exact same time. And the big question is, which one is the market going to believe? Well, we got our first answer right after the earnings call. The stock absolutely ripped higher, jumping over 8% in after-hours trading. So you gotta ask yourself, what on earth did investors see that got them so excited? You know, it really boils down to a classic good news, bad news situation. But in this case, the market decided to pretty much ignore the bad news and focus like a laser on one single very surprising number. And here's that contradiction, laid out plain and simple. On the left, a monster earnings beat. Wall Street was braced for a 4-cent loss, and Tillys delivered a 10-cent profit. But then look to the right. Revenue actually missed expectations, and it was down over 7% from last year. So how in the world does a company make more money when they're selling less stuff? This is why that profit number was so huge. It wasn't just a beat, it was a major milestone. As the CFO pointed out on the call, this was the company's first profitable quarter in almost 3 years. For a stock that's been beaten down, this was the exact data point, the proof of life that the market was desperately waiting for. So let's solve this puzzle. How do you pull a profit out of a hat when sales are falling? Well, for Tillys, the answer was a textbook turnaround strategy. It was all about getting back to basics, focusing on discipline and controlling every single cost. Step 1, they got absolutely ruthless with their inventory. They cut it by a whopping 14.5% compared to last year. Management didn't mince words on the call either, basically admitting, yeah, we had just been buying way too much stuff. This was all about getting lean and making sure what they did have was fresh. Step 2, they took a scalpel to their overhead. They sliced their selling, general, and administrative costs. Think store payroll, corporate salaries, that kind of thing, by a pretty hefty $4.4 million. And here's the beautiful result of all that hard work. Because they had less inventory and it was newer, their product margins expanded by a massive 210 basis points. What does that mean? It means they sold more stuff at full price and didn't have to resort to those deep profit-killing sales to clear out old merchandise. Now that term basis points, or BIPS as you'll hear it, might sound technical, but it's super simple. 100 basis points is just 1%. So that 210 basis point jump, that's a full 2.1 percentage point improvement in their profit margin on everything they sold. It just goes to show how these small, disciplined changes can have a huge impact on the bottom line. Okay, so that was the past. Let's look to the future. Because while last quarter was a clear win for cost control, management's outlook was, well, a lot more cautious. Plus, there's a huge new variable in the mix, a new CEO. Yeah, take a look at this. Even though they had a decent start to August thanks to back-to-school shopping, their guidance for the full third quarter is for another loss. Management basically said that, historically, sales fall off a cliff in September and October once that need-based shopping is done. So they're baking that expected slowdown right into their forecast. But, you know, the official numbers aren't the only question mark hanging over this company's future. There's something, or rather someone, else. And here's the biggest wild card of all. A new CEO, Nate Smith, who literally started the job just 2 weeks before this earnings call. Now, he's got a great resume with experience at places like Oakley and Boardwriters, but for now, he's just getting his feet wet. His main message was that he's going to double down on those things that are working well. For investors, though, what he's going to do long-term is still a giant question mark.
All right, let's put it all together. You've got this surprise profit, which is great, but it's driven by cost-cutting, not by growth. That's fighting against declining revenue and a really uncertain future. So what does it all mean for the stock?
After weighing all the pros and cons, all the good and the bad, where do we actually land on this thing? We are initiating our coverage on Tillys with a market perform rating, and the reason is pretty straightforward. Right now, the risks and the potential rewards just feel very evenly balanced. Let's break it down. The good? This self-help story, this focus on cost control, it's clearly working. They're profitable again. The bad? Sales are still going in the wrong direction. And the big unknown is the new CEO. We just have no idea what his long-term plan is. Until we see some sign that the sales trends are stabilizing, it's just really tough to get more bullish. Okay, now for my favorite part, the trade idea. This is how we'd actually pitch this story to an investment committee. The play here is a classic pairs trade. You go long on Tillys, ticker TLYS, and at the same time, you short the broader retail ETF, which trades under the ticker XRT. And here's why this makes so much sense. This isn't a bet on the American consumer or the health of the retail sector. Forget all that. This is a bet purely on Tillys' execution. You're isolating their internal turnaround, the cost cuts, the margin improvements, while hedging yourself against the whole sector, which is facing major headwinds and is super promotional right now. I mean, just look at the performance. Over the last year, Tillys is down 60%, while the retail ETF is up 17%. If Tillys can just keep stabilizing its own business, there is a ton of room for that gap to close. So at the end of the day, Tillys is a really fascinating story of internal discipline fighting against external pressures. The next quarter is going to be absolutely critical. We'll be watching to see if the new CEO can finally get that top line growing again. And as always, this analysis is just for informational purposes and is not financial advice.